Meantime, we're going to talk about this meme stock trading mania. Seems to have come back this month with names like Bed Bath & Beyond up almost 450% since the first. CNBC Pro out with a new screen trying to catch the next meme name, pulling out any S&P 1500 stocks above $1 billion in market cap that are 50% off their highs and have at least 10% short interest. Tech names from the list, well, Etsy and Dish Networks, both around 60% off their highs with 11% short interest. I don't get it. I don't understand what is happening with these meme stocks, Dee. I'm baffled.
Did you ever?
I thought that some...
Is it supposed
no,
to
but
make
I thought
sense?
that people... I thought that it didn't make sense the first time. I don't think it makes sense now, but I thought that folks had sort of learned their lesson the first time. I thought they were using, we were told they were using stimulus checks and the like to do it.
Yeah.
A lot of folks lost. And so I sort of think to myself, who are these people?
Where does the money come from?
Where's the money coming from?
But let me ask you this, Andrew. Okay, it still doesn't make a lot of sense. However, does it make sense to an Adam Aron who has been able to really use it to his advantage and raise some $2 billion? What surprises me, and we're going to talk about this in a little bit, that more CEOs aren't using this playbook.
Well, I think there's a question about using this playbook. Look, he has used this as successfully as a CEO can. At the same time, it has been, and I know we can debate this, was it at the expense of his shareholders or not? There's a big dilution factor here. You could also argue on the other side that if they hadn't done that, they wouldn't be alive today. So it's a complicated story. Do the shareholders fully understand all the ramifications of what's happening? That's the part that worries me.
Well, they're cheering him on, the apes at least. By the way, number one on that list, on that CNBC screener, is a company called Trupanion, a pet insurance company. Nearly 50% off of its recent high, nearly 20% of its float is short. I can see it. Pet insurance kind of has a Ryan Cohen
I don't know. Are you
there.
Can you see Bed Bath & Beyond at 60 to 80 bucks? Ryan Cohen's buying options at those prices.
But we look at fundamentals, Andrew. We're not, chasing this momentum and looking for the secret sort of the Easter eggs in it. So I don't know. We're the wrong audience, I suppose. We're going to stick, though, with the meme trade. Maybe someone else can make sense of it for us, Andrew. We're going to bring in Wall Street Journal reporter Gunjan Banerjee. Let's start there. Gunjan, what is going on? Can you understand it any better than we are?
Look, it seems like the meme stocks are back, at least for now. With Bed Bath & Beyond, we're seeing this struggling retailer. It's burning cash. Its bonds are trading at distressed levels. Yet take a look at what's going on with the stock, with the options. Yesterday, Bed Bath & Beyond calls were some of the most popular options in the entire market, behind options tied to SPY. So we are seeing something that's reminiscent a little bit, of course, of last year's meme mania.
Yeah, so what does it tell us, Gunjan, then? Let's be practical about this. What does this tell us about the broader rally when we've seen the NASDAQ come back some 20%? Andrew and I were talking about it a little earlier. These are low-quality names. Does that make it a low-quality rally?
I'm not sure if it makes it a low-quality rally, because broadly we have seen some of those recession fears ease lately in terms of this rally. But I would like to point out that we've seen the memes come back from time to time. We saw that at the end of the first quarter, when the broader market started rallying. We saw the memes come back a little bit. But this does tell us that speculation is not gone from the market. We saw retail purchases of options hit the highest level since April recently. Obviously, these meme stocks are going crazy again. For all the gloom and doom that we started this year with, and that we saw for a lot of the year, people are still willing to jump in, and they're willing to speculate.
Right. Gunjan, I hate to be too paternalistic about the situation. How much of this is really the retail trade versus how much of this is the institutional trade riding on the back or perhaps even taking advantage of the retail trade?
So what's really interesting is that I saw some data showing that individual investors' purchases of Bed Bath & Beyond recently surpassed levels that we saw in 2021, which kind of shocked me because when we think about the meme stocks coming back, I think broadly speaking, activity has been below levels that we saw last year. And at first, at least, it seemed like this isn't a redo of GameStop. But at least with Bed Bath & Beyond, we are seeing purchases surpass those levels, though I'm sure institutional investors are also in the mix.
I wish we could figure this out, but how many of the traders, retail or otherwise, that are putting on this trade, do you think were the same folks putting on the trade a year and a half ago at this point? Or do we think this is a new group, a new gang?
One thing that I think is really, really important to keep in mind is that things have changed since early last year. Even when you look at Wall Street bets, people I was speaking with earlier this year said, a lot of the veteran traders have left Wall Street bets. So this cast of retail investors, it has evolved. And I think it's tough to paint it with a broad brush. And I would be reluctant to say, hey, it's the exact same people. Though I do think a lot of professional investors kind of thought retail is going to, flee the market as soon as things get tough. It doesn't look like they've done that. A lot of retail investors have hung around. We recently saw retail investors make up around 12% of equities trading.
Right. And Andrew, I'm kind of picking up because I saw your conversation this morning with Tasty Trade founder Tom Sosnoff, and he was talking sort of about the bigger picture here. And it's a good thing when people get excited about finance. And Gunjan, you were talking about, whether these are the same people that we saw last year. Is that a good thing? Should they have moved to more sophisticated trading? What does that tell us about the retail investor, especially the one that has come into the market over the last few years?
If there's anything that I've learned covering retail investing the past 2 years, it's that you really cannot paint them with a broad brush. Yeah. You have a lot of retail investors who are buy and hold. They're buying and holding index funds, and they didn't sell during the tumult that we saw, even while some professional investors seem to be selling. And then you have the retail traders who are playing in options, playing in meme stocks. So I think it's important for all of us kind of looking into this to keep in mind that they're not all the same.
I guess the question that I wonder about, and I'm on Wall Street Bets and otherwise looking at people talking about Bed Bath, I just don't know. Do people realize this is a company who has not earned a profit, at least that I can tell, since basically 2018, and has something like $3 billion of debt. So I sort of don't understand the calculus, and I don't also understand the calculus on Ryan's side in terms of why he would buy those options. I know they're cheap. They're and it's a big bet. But what do you think's behind this?
Look, I think the calculus of fundamentally the business is doing well, so the stock can't skyrocket, that hasn't worked out. When you and Deirdre were talking about, the meme playbook of issuing shares to kind of capture this momentum, that's actually helped companies fundamentally. That's helped them improve their businesses. And I think that's really important to keep in mind. And we're seeing Adam Aron do that. And that has helped his business during the pandemic. And it has helped it the past few years, was tapping into the retail enthusiasm about his stock.
It's also made some questionable acquisitions. By the way, Baird putting its price target for BBBY, $4, kind of says a lot. The retail investor versus Wall Street. Gunjan, thanks so much for being with us, as always. Meanwhile, the whales are making some big bets. We've been talking about it, and sales, of course. Chip stocks as well this quarter. Christina Partsenevelis joins me here at One Market with more. Christina, welcome. It's great to have you on set.
I know. I'm so excited to be sitting next to you. But let's talk about these big players because they are dumping the chips. You've got the lepast 13F filings that show that popular semiconductor names are falling out of favor, with Micron taking most of that brunt, or taking most of that hit. David Tepper's hedge fund Appaloosa dropped its Micron position by 73%. Baupost dropped it by 12%. David Einhorn's Greenlight completely dissolved its stake in Intel. You also have Baupost that also dropped its Intel stake by 47%. Intel stock is down, about 2% today, and only one of the only stocks right now, the tech stocks on the Nasdaq 100, that hasn't jumped higher since the June bottom. Coatue slashed its Nvidia holding by 92%. Recall both Nvidia as well as Qualcomm have issued weaker forecasts going forward, but not everyone is saying goodbye. The Soros Fund almost doubled its stake in Qualcomm, and Viking Global picked up over 1 million shares in Micron.
I'm glad you bring up the June bottom because it is remarkable what we've seen since then. And Andrew, this has already been one of the largest and sharpest semi-corrections that we've seen in over a decade. So these 13Fs, they're backwards looking, but always the question, where do these semis go now?
Well, I want to see the 13Fs next quarter, because
Yeah.
I think they may be very different than what we're looking at right now. We'll see. Meantime, we should tell everybody that Deutsche Bank pressing pause on Take-Two downgrading the name to neutral as they say the stock's range-bound with a few positive catalysts ahead, at least in the near term. More market action after the break. Don't go anywhere. We're coming right back.